Hello, everyone, and welcome to NP Capital's Small Business Essentials series, where the NP Capital team reveals actionable strategies that can help your business thrive. Nick and Brent, who are both partners at NP Capital Advisors, will be leading our conversation today. For those of you who don't already know, NP Capital is a next generation investment bank and consulting firm founded by a team of experienced entrepreneurs, bankers, and attorneys who have built, operated, and sold successful businesses. The firm offers tailored solutions across M&A, restructuring and turnarounds, and strategy and growth consulting in a variety of sectors. With a performance-driven fee structure and a track record of delivering exceptional results, NP Capital Advisors is dedicated to helping founder-led and emerging growth businesses maximize value and overcome challenges. So first, Nick and Brent will start with a discussion of the topic at hand. Lenders want you to refinance, but should you restructure? And then we'll take some Q&A. So please put your questions in the chat. Without further ado, we'll get the presentation going. I'll share my screen and Nick will kick things off.
Thank you, Hannah. I really appreciate it. Yeah, exciting topic today. I think we're going to be talking a little bit about something that is facing a lot of companies and could probably going to get worse before it gets better. And we go through these cycles, right? And there was a period, a few years back when lenders were lending a little bit more freely. Interest rates were lower, so the cost of debt was lower. And they were the lenders were financing these companies with the kind of a formula that relies on a multiple applied to what's known as adjusted EBITDA, right? And the math is basically, if a lender is going to give you, let's say, 3 or 4 times leverage, and you multiply that times the adjusted EBITDA, and the adjusted EBITDA is $1 million, then you can get $3 to $4 million of debt on that company. Now, the adjusted EBITDA is often, a little bit of a vague number. It includes your EBITDA plus some add backs and things like that. Different lenders allow different types of add backs, and also in different environments, you're going to get away with less versus more. We all probably remember those days of the mortgages when they had those stated income mortgages where you didn't even have to give your tax returns or anything, and they just took you for your word. And we all know what happened to the mortgage crisis after that. So it goes in similar cycles with business financing, and I think right now we're headed for kind of a fairly large refinancing wall, which is basically caused by the fact that now with debt multiples going lower, debt becoming more expensive, and lending standards tightening again, you're going to get a lower, multiplier on a lower EBITDA figure. So, whereas before you may have gotten, 4 times on a 1 million adjusted EBITDA, today that same company may get, 2.5 or 3 times on an even lower EBITDA because the lending standards are tightened so that they won't get away with as many add backs in the EBITDA. And that delta is what's known as the refinancing wall. I'll turn it over to Brent to talk a little bit more about that and how that all kind of plays out in terms of the EBITDA illusion and the refinancing math. And then I'm going to come back and talk a little bit about what lenders want you to do and how we think, you should approach it, because there is a little bit of a conflict there in terms of what we think is best for most of our clients versus what often the lenders are pushing them to do.
Thanks, Nick. So that's a helpful intro. I think what's important for to kind of set the stage here is to understand where we were and where we are now, right? So the reason why, this EBITDA illusion and refinancing wall is so prescient today is because it was about 5 years ago when, the markets were, I think everybody remembers, very, very hot, right? Everybody was transacting, company was flowing capital was flowing very, very freely, interest rates were very low, and everybody was just trying to put money to work, right? Generally, when people put money to work, it can be in the form of debt or equity. The purpose of this conversation is a discussion around debt, right? So you had two main factors that occurred, right? Interest rates on new debt were extremely low, right? Lowest in our lifetimes and probably realistically that we're ever going to see again. And in the context of financing a company, underwriters look at what the future of the company looks like, right? In this 2021 period, the future of every company looked bright and projections were very, very rosy, right? This was 5 years ago. what I think and what Nick and I see in our business is a lot of these operators who either purchase these companies or refinance their businesses is they don't necessarily appreciate the time function of these financings and these debt instruments that they took on, right? In that every, generally 5 years, there's a forced refinance by the institution, right? So that's, 5 years ago, that's where we are now. So, that's kind of setting the stage for why we are where we are. Um, as far as the process for how these companies were financed back 5 years ago, again, lenders looked at what the future of these companies look like. The, future was very, very positive at the time. And not that these companies haven't done very well, right? Just the environment has changed. We've had a ton of inflationary pressures, a lot of changes in the technology landscape, right? Which have been a lot of pressure on the earnings of these businesses right about the time where we're at the refinancing point. So what does this all mean, right? Ultimately, at the end of the day, a company has to service the debt, right? And cash is what really matters in cash flow, not how much debt you think you can service. It really, after 5 years of having it on the business, how much can it service today? Okay.
In other
So
words, I think you're talking, Brent, about the difference between EBITDA on a P&L statement and cash flow, true cash flow, right? Right.
exactly,
Because you have
exactly.
like operating expenses, depreciation, amortization, other taxes, other things, those eat into the cash. And so your cash is not equal to your EBITDA and definitely not equal to your adjusted EBITDA.
Correct. And now we're to the point where, the partners with these businesses, the financing partners have actually seen what true cash flow looks like, right? So, we call that in our business the EBITDA illusion, and we'll talk about next what the refinancing math looks like now that we are here today. So, after the business has been financed for a period of time, in this case, about 5 years from the frenzy of the COVID time, right? Most of these businesses are in a position where they have to either take out a new, financing relationship or extend the one that they currently have. Okay. And that is a, process similar to the initial process that they undertook when they either acquired or refinanced the business. But the reality is two thing is really twofold, and I kind of spoke about it a little bit in the first section. Is earnings are under pressure, but rates are also higher, right? So there's these really two big factors that are causing extreme pressure to a lot of businesses and our clients specifically, which makes the refinancing math very, very challenging, right? Lenders, have tightened what they're looking at, and it's more of an implicit tightening, right? Because they're still looking at the future, right? But the future isn't as bright as it was because earnings are under pressure, and now the interest rates that the businesses can support are much higher.
And
So
also some of the add backs that they may have gotten away with in terms of what was considered the adjusted EBITDA may not be allowed, in the more tighter credit standards.
exactly, exactly. So Nick talked about it in the intro, right? But that $1 million of earnings that a lender would have lent against it, call it 4 times back 5 years ago, it's 4 times, $4 million of debt in that example, right? Might only be, $500,000 still at the 4 times, but that's a $2 million difference, right? The 500 times four versus 1 million times four. So that's this refinancing wall and gap that we hear
So,
and
and
talk
it could
about.
get worse
So
if the leverage multiples drop. So could it be 3 times 500,000? So it could be delta could be even higher, right?
exactly, exactly. So the current terms are much much worse than they saw before, and this is a challenge that Nick and I see on a daily basis, and that a lot of businesses are working through at the present, and we feel like we can be super helpful with. Um, with that, I'll kind of pass it over to Nick, and he'll talk through the idea behind how you restructure it versus refinancing it.
Thank you, Brent. Yeah, I think the other thing that we see too, which is really crazy, is that like by the time that many of these clients come to us, they've done what we call stacking. So basically, initially they took on this first debt, right? This initial larger first lien. It's called first lien debt, the first lien on your house, on your business, and then often they start getting tight on cash and they need more money, and so then they go out and get debt behind that debt. That's what's called the second lien debt, right? That second lien debt is always more expensive has tighter standards than the first because it's more risky. And you can get less of it. Think of it again back to the housing analogy. If you remember when a lot of folks were getting their first mortgage, which you can get usually up to about 80% of the home value, and then you get a second mortgage for about 10% of home value, right? Which is always more expensive. It's a similar analogy here. Then often they even go a step further to go get even third and fourth liens. Often with in some cases, in many cases actually that we've seen, they get to this super crazy expensive debt, MCA, the merchant cash advance type debt, which a lot of our clients have, which even has personal guarantees and some really crazy stuff. And so they're keeping stacking debt on debt to basically keep making payments on the original debt. So effectively, that first lender, things they were having struggling to make those payments, so they got more debt to be able to continue making the first lender's payments. Then they're struggling to make the second lender's payments, and they get more debt to make the first and second lender's debt payments, and now they're just stacking it up, and so pretty soon they hit, they're like, there's nowhere to go. There's no more, stacking, and the company's in real trouble. And so they come to us, and each lender, by the way, along the way is encouraging them to continue paying their payments and not to miss a payment, and threatening what they'll do if they do miss a payment, and saying, "Hey, why don't you just take us out altogether if you want, and you can just refinance us with someone else." And that someone else, because standards have changed and times have changed, is always going to be more expensive and a lot worse than that original debt you got several years ago. So when we come in, one of the first things we do is put an end to that. We tell our clients, look, we're not gonna, the lenders want you to do something which is best for the lender. That's not what's best for you. We're gonna have to take some extreme measures here. We're probably gonna have to miss some payments, and we're probably gonna have to say no. And we push the our clients to force the lenders to restructure the debt instead of refinance and take the debt out. And that's, in our, at least in the situations I've seen, almost always better for our clients. It leads to resolutions that typically would be far better than stacking even more expensive and even worse debt. And we often wish these clients had come to us even earlier, before they even started that stacking process. But we have some interesting case studies around this too, that we wanted to discuss, and talk about a little bit. So one of them, the first one, is this beverage company that we have as a client. A very interesting company, very interesting entrepreneur, amazing product. Doing about 30 million-ish in revenue. And they were basically getting to the point where they had two lenders and some other smaller ones, but mainly two lenders that they were paying a lot of money to on a weekly basis. And they were at the point where in literally in the next week or two they were going to run out of money. And so they came to us, and the lenders were pushing them, especially the second lien lender was pushing them to just take them out. And they had an opportunity to take them out with another third lender that would have been incredibly expensive, but was willing to give them the money to do so. Luckily, we came into the picture just before that. We said we put an end to that, prospect of taking on that crazy expensive debt. And we basically started conversations with the first lien and second lien lender by the way, doing exactly what they were afraid to do originally, which is we just stopped paying them. And you often have to take that initial step, even though it's a scary step, to get the process rolling. And then we had some, tense moments, of course, with the lenders. But ultimately, the lenders were also appreciative of the fact that we came in, we as a third party took control of the situation. We started managing the cash flow. We started monitoring the cash flow, measuring it, forcing the company to in a disciplined way to look at what they're paying, what they're not paying, and monitor the cash much more tightly, which the lenders actually appreciated. And then we were able to convince the lenders to basically cut the payments in half, in one case more than half, almost to a third, and push the maturity of those out several months, and waive all penalties and fees, which would have been is a far, far, far better outcome than to take on much more expensive, egregious debt with a lot more penalties and other things, personal guarantees, and et cetera, to pay these original lenders out. So it was a huge win for the company, and everyone was happy with the outcome. And in fact, we just paid off the second lien lender in full last week, and now we're about a month away from paying off the original lender, and even the lenders are thrilled with what has happened. So it's turned into a win-win-win. We had another client that's a meat snack company, protein snacks company, doing a little bit over 20 million in revenue. they had, there's a bunch of different things we were doing for them, by the way, but I'll just mention, one of the key things relating to this. It was their second lien debt holder who owed about $7 million. The original principal was only like 4 million, but they had 2 million in penalties alone, and then other interest and past due stuff that had tacked on. And again, they were pushing the client to, come in and buy them out and the client had an opportunity to take on, really, really expensive, merchant cash advance type debt or other options. And we again came in and put an end to that. And we were able to almost indefinitely extend the maturity. In fact, it's still being extended. And we get a variety of other penalties and things waived, and ultimately reach a resolution that allowed everyone to continue on. And again, in that case, also the vendor appreciated. We do weekly communications with the vendor. That kind of communication and honesty is really important because that's something that is often missing in these situations when we first get involved is that visibility and that communication. And it turned out to be another successful outcome. So these are really tense and hairy and difficult situations, but it's something that we have become particularly adept at handling. And I think ultimately what it comes down to is you don't want your lender coaching or guiding you on what to do when you hit these difficult situations. And often what they say, and often even what seems intuitive, is exactly what not to do. And it is, some of the steps we take are a little counterintuitive at times, but there is some best practices in this. And we've talked about some of this stuff in some of our prior podcasts, and we'll continue to talk about them in the future. But yeah, we're pretty excited about the work we're doing here. And it seems like it's only going to become more relevant.
Thank you so much. That's so helpful. And I think you highlighted a few key points that it would be really important for folks to take away. Like one, the lender's best interest is not necessarily the company's best interest, as you just said. And so it's really important to figure out what works for you and your specific debt situation instead of blindly following what the lender suggests. Two, that timing is important, and the earlier they can, start changing things, the better, in a lot of cases. And working with a third party like NP Capital helps a lot with those conversations and navigating those very difficult situations and territory. So really, really helpful takeaways. So now we'll do some Q&A.
Thank you.
Um,
And just so FYI, we've been able to do that not just in these debt situations, but also even with vendors and other critical parties that are owed money. Whether it's landlords, vendors, a variety of other situations.
well, that's really good to know. Okay, so the first question is, what are a few things you look at when a new client comes to you with a lender who's asking them to refinance?
Well, I mean, first we'd like to get what I call a lay of the land. And Brent is a master at he's created a great template to help achieve this. But effectively, we try to understand what is the total liabilities, that the company owes to who. So which party, how much is owed, what was the original principal, what are the interest rate, what are the basic terms? Is it first lien, second lien? Is there a personal guarantee? Is there not a personal guarantee? Is it secured? Is it unsecured? If it's secured, is it properly secured? Because even if it's technically secured, if they didn't take certain steps, they don't have a proper security interest. Is there within being secured, is there a UCC lien filing or not? All of these little elements and little things matter. So that's one of the first things we like to do is get a full lay of the land, and then that will help us assess what we can do and what we can't do.
And that leads into the next question, which is, what are some leverage points that a borrower has when negotiating with an existing lender?
Yeah, I mean there is again that first step I just described is exactly why we do that step, because that leads us into the second, which is the leverage points, right? And leverage points change and are very fact dependent based on all of the different answers to the questions I asked earlier. So for example, the least leverage you have is with if you have a first lien lender that has a fully secured interest that's properly perfected, has a UCC filing, and has a personal guarantee. That's going to be the most difficult. That lender has the most leverage against the company. But you still have leverage, and part of that leverage is depending on what kind of assets you have. to even cover that. If, for example, if your asset base is so low that they're what I call underwater, meaning that the lender collateral is no longer worth what it was, and they're going to have to go after their personal guarantee to collect in full. Usually, that's a very difficult and arduous process, and lenders don't want to do that, so they're going to work with you. But now moving into the second lien lender who has less, you have more leverage against them than the first lien lender because the second lien lender can't really do much without paying off the first lien. So they're, what's known in the second position. And then if you have unsecured lenders like vendors and real landlords and stuff like that, they're even in a worse position, and you have a lot more leverage with those kind of folks. Ultimately, the biggest leverage, though, is that most of these companies, especially the size of the company we deal with and the markets at which we deal with, they are worth a lot more what I call alive than they are dead. So there are situations, in certain classes of the economy, like let's say real estate or others, where there's the collateral, the hard assets, what's going on as hard assets collateral is worth a lot, which could be things like real estate or inventories or equipment or farmland or anything that's known as a hard asset. But we deal in the world where mostly our company's biggest value is their intangible assets, which is called the soft assets, which is an intangible assets only typically have value when you're alive, except for intellectual property. And even the value of intellectual property, which is a soft asset, is much, much greater while the company's alive than when it's dead. So I call it the golden goose philosophy, and everyone's interest is to keep the goose alive and laying eggs, because if you kill the goose just for that last egg, the goose will never lay another egg again.
Yeah, that makes sense. And so interests are aligned after all. Everybody wants the company to stay afloat. Um, so the next question is, working capital is often cited as a cash unlock. What are some common things that companies are leaving on the table?
Brent, you want to cover that one?
He had to drop.
Oh, sure. Sorry, can you repeat the question? Huh?
Yeah, totally. So working capital is often cited as a cash unlock. What are some common things that companies are leaving on the table?
Oh, well, I mean, a lot of these hard goods companies that we deal with, they tie up a lot of money in what's known as working capital, right? And your working capital is basically your accounts receivables, which is money owed to you, but it's not cash because it's owed to you, right? So it's on your books as accounts receivable, and it's your money, but you don't have it yet, right? Then you have what's the account known as accounts payable, which is money that you owe out, that you owe to other people, which is a negative against it, right? So the positives are the accounts receivables and the inventory. Inventory is yours, it's your asset. But again, it's even worse shape than accounts receivable, because at least accounts receivable, you're going to receive cash, and then it'll be then you'll have it. In the case of inventories, you first have to sell it, and then it generates an accounts receivable, and then you have to get the cash. So there's two steps to get to turning it into cash, right? Um, those are the pluses, the big pluses, the accounts receivable, the inventories, and then the big minus is accounts payable. And then there's of course other bunch of other stuff which I won't get into on this. But to the extent, and this is what we call the working capital cycle, to the extent you can collect faster and pay slower, which by the way the big guys are masters at doing, and turn inventory fast. So inventory turn fast, collect fast, pay slow. That's how you maximize your cash flow dynamics. It's a simple formula, but so often overlooked and not done well by so many companies.
That makes sense. I feel like it's one of those things that's easier in theory than in execution. So next question is, how do you handle management teams that are emotionally attached to adjusted EBITDA numbers that don't reflect cash reality?
Yeah, that's a big one. I mean, we often come across these owners and founders and owners, and they're looking at their P&L, right? And they're tied to this number that this like is being spit out, and maybe their finance team is adding back adjustments and this and that, and they're like, oh, look how well I'm doing. Here's this great number that I'm doing, and then you come in, you tell them, listen, this is nowhere, and they somehow mistake that with the amount of cash they have available to do stuff. And often one of our biggest things that we do is educating them and teaching them that wait a minute, you're not that money that you see on there is not real money. You're not collecting that, and you're not putting it into your bank. Like there's a lot of things that are along the way that are diluting it down. Like in the consumer and food and beverage business, one of the big ones is gross to net dilution. Like how much people bill in AR and how much they actually collect. We all know the famous stories of these distributors that suck a bunch of fees and random things out of this money, and you think you're going to get a $50,000 check, and $30,000 shows up. right? And so the 30,000 is the cash you have. The 50,000 is the number that's sitting on your P&L often. And there's a big mismatch between what these founders think that they have and what they actually are collecting. And that process is often an education and a difficult one.
Mm, that makes sense. So the last question is, in the beverage company situation, what would have happened if they had just taken the lender's advice?
Yeah, I mean, what would have happened is they probably would have taken on this much more expensive debt. They would have paid out the other lender that had an even bigger, ch challenge on their plate because there was no way they could have continued making the payments to that third party given the cash flow dynamics of the company. And then they would have been, had an even more aggressive lender, an even more difficult situation to work with. And again, we've managed our way through out of those situations also, but it is the earlier we can get involved and the earlier we can help, typically the more we can do.
Mm, yeah, it's always good to start early when possible. Awesome. Well, thank you both so much. This was a really enlightening conversation and particularly timely given the refinancing wall and what we have coming. So, if you're a founder or CFO or business owner listening to this and you see yourself in this situation, now you know you can reach out to NP Capital at info@npcapitaladvisors.com. And yeah, if you have any questions, reach out to Nick or Brent. Thanks everybody for joining.
Thank you, Hannah. I really appreciate it.
Happy to.